Hello everyone, welcome to the Brainless Investor YouTube channel. Today we'll be discussing the difference between account receivable and account payable. So first we'll be looking at account receivable. So what does it mean by account receivable? It means this is the money owed to you by the customers, means the customer owe you money, right? So when your business sells the goods or services on credit, meaning the customer will pay later, that amount becomes account receivable, right? It can be considered a line of credit extended by a company and normally have terms that require payment to be made within a certain time of period. It is considered an asset on your balance sheet because it represents the future cash flow. For an example, if you sell $1,000 worth of goods to your client who promises to pay in 30 days, until they pay, that $1,000 sit as account receivables on your books. Whereas account payable is the complete opposite of account receivable. So account payable is the money you owe to the suppliers or vendors. Account payable is a short term of liability representing a company's obligation to pay off outstanding debts and creditors to suppliers, right? So when you buy goods on services on credit, you get the goods now and pay later. That becomes an account payable. So for example, your credit card, if you spend $20 at Target, you don't pay it now, you pay it later when the statement come out, right? So it's considered as a liability on the balance sheet because it represents future cash outflow, right? So managing account payable can well improve cash flow and keep up good vendors relationship. If you pay them on time and everything, they'll likely to do more businesses for you. If you pay them earlier, it's much better. So for example, if you pay earlier for your credit cards, bills and all, then you're unlikely to get the 17 or 15% interest due to your late payment. So we can look at another example. You order an office supply worth of $1,500, agreeing to pay the suppliers within 60 days. Until that, the $1,500 is recorded as account payable. In summary, let's look at the difference between account receivable and account payable. So account receivable, customer owes you money. It's a type of asset. It belongs as an asset section in your balance sheet. For example, you sold $1,000 of good, payment is due in 30 days. Cash flow impact, it is a future cash flow, money coming in. The account payable is the opposite, as we mentioned earlier. You owe money to the suppliers and vendor. It is a liability. Of course, in the balance sheet, it belongs to the liability section. You bought $500 of supplies. The payment is due in 60 days, and it is a future cash outflow, money going out of your account. We hope you enjoyed our video today. If you liked it, please leave a thumbs up and subscribe to our YouTube channel.